United Airlines delivered another strong performance in its latest earnings report. Delta Airlines reported on the 10th. They also had slightly better than expected numbers. We're going to talk about both of those two stocks and which one is the better bet right here and now, today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. So, as I just pointed out, United Airlines reported earnings yesterday. After the close, they reported just under $14.7 billion in revenues. That was about 2.4% above the consensus estimates, and earnings of $3.05 a share. Those also beat the consensus estimates by almost 7%. Now, this follows Delta Airlines' January 10th earnings release, which also exceeded both revenue and earnings estimates, although only modestly. Now, both of these airlines have highlighted an atypical surge in winter travel demand, a period that traditionally sees a slowdown following the holidays. And this trend reflects a changing travel landscape, with consumers showing sustained interest in flying during what has historically been a quiet season. So factors that may be contributing to that could be flexibility in work arrangements, although as we've been seeing from the pronouncements coming from the new administration, those flexible work arrangements, at least for federal employees, may be coming to an end. We've also seen the JP Morgan facing some resistance, but has also been encouraging or asking specifically for employees to return to work on the job rather than working from home. There also has been a rebound in international travel. So that has probably also contributed to some of this strength. So United's share price has outperformed Delta over the past few months. And so I'm going to just pull these two up very quickly so we can compare them. And I happen to remember, because I was looking at this earlier, that the lows from last year were on the 5th of August. And we've talked about this stock before, and we've talked about the relationship between these two. I don't think we really need to have the industrials in here. The industrials have essentially sort of kept pace with the S&P, maybe trailed it by 150, 200 basis points or so. But this is what we're looking at right here. As you can see, United Airlines has outperformed Delta massively. It's outperformed almost everything. It's up well over 180%. Just since early August of last year. Delta not too shabby at just under 80%. Now, a big portion of the reason for this relative outperformance stems from the fact, and I think I had this preloaded, hopefully I did. So that's revenues and EPS. I thought I had something else in here. Let me just get this in here. So one of the reasons for this was that Delta has long been one of, if not the favored airlines in the space. And what had happened, I'm just going to go back 1 year here so we can compare these side by side, was that Delta outperformed United for a while, and we saw this big gap in the earnings multiple. So if you take a look at this lower chart right here, as of August 5th, that's this moment right here, you can see that the white line indicates what the price to forward earnings estimates, I should say, for United was relative to Delta. That valuation gap is a big part of the reason. So both have appreciated, but the reason that United has appreciated so much more was because there was this enormous valuation gap. And as it narrowed that gap, it outperformed. Since that time, now what we can see is that, in fact, actually at one point today, I think the United valuation actually exceeded on a price to forward earnings basis that of Delta. It has since come back. In fact, actually, its intraday performance was a little bit weak. So let's just take a quick peek at that as well. I think peak to trough, it actually fell more than 5%. And let's just see. I should probably put 2 days in here so we can get a cleaner look at it. Looks like it closed almost on the lows, but let's just take a quick look at its intraday performance. So gapped higher, closed lower. Down 7% from its high print, although I don't think we can really say that a lot of volume traded there. But the high print on the day, it fell about 7%. Now, this is not a great technical setup, I have to say, when something gaps higher and closes lower, although it is, in fact, only modestly lower relative to yesterday. But not a great technical setup. Be that as it may, the question that I'm really more interested in right now is, of these two stocks, which one do I now favor? Having favored United over Delta on that valuation gap, something I think we touched on several months ago. And we're actually going to be talking about a different pairs trade that I also talked about several months ago, right after we get through this one. So here's the story. Right now, the free cash flow yield for Delta on a forward-looking basis is likely a whole lot better. So the street is looking for better than $4 billion in free cash flow for Delta. These two companies are not that different in terms of their scale and scope. So to put things in perspective, United Airlines, $35.5 billion market cap, $55 billion enterprise value in round numbers. So we're looking at about $20 billion in net debt. For Delta, those numbers are just over 43 billion and just over 63 billion respectively. So once again, about $20 billion in net debt. Revenue picture, about 10% different. So we're looking at 60, not even actually. So the forecast for United's revenues, full year 2025, ending end of December of this year, is just under 61 billion for United, and it's about 61 billion for Delta Airlines as well. Now, I charted something else here which I want to show you before I get to the real point of this. So I find that kind of interesting that there's a divergence here in terms of the revenue growth expectations for both of these two, given that, I'm just going to blow this up a little bit, this is a 5-year history, quarter by quarter, of the revenues of these two companies. And Delta is going to be in blue and United in green. And are there differences? There are differences. I have plotted those differences down here. So this little column chart is basically showing us the percentage change difference between United and Delta. And we can see that there were a couple times when there were pretty big gaps. But in general, what we see is that the growth rates of these two in terms of revenues track each other pretty closely. So I just think that's kind of interesting that the street is looking for a very different number in terms of year-on-year growth, because what they are looking for here on Delta is basically flat to slightly declining revenues year-on-year versus a 6+% gain for United. Let's assume that's correct for the moment. But I just wanted to point out that the revenues of these two businesses, because they're, to pardon the pun, if you will, but macroeconomic headwinds and tailwinds are going to affect both of these businesses in a like fashion. So to see a big divergence like that surprises me a little bit. But the more important point that I would like to make is that the free cash flow projections for these two is actually very different. So you have two businesses that are about a $60 billion enterprise value, give or take. Take a look at this number, though, if I can blow this up a bit and use the fancy annotation tools that I have been provided. So using this box, I just want to show you what to pay attention to here, right down here. Okay, so free cash flow for 2025 for United, forecast is about $1.5 billion. Could be a little bit better than that based on the numbers that the company was talking about. Compare and contrast that then with the numbers that we are looking at here instead. And what we're seeing, again, I'm just going to highlight that. I'm going to get better at this over time. 4.3 billion. Okay. So 4.3 billion, if you're looking at it, so when people talk about free cash flow yield, they're usually looking at free cash flow over market cap. I would say that as often as not, I'm interested in taking a look at it on an enterprise value basis, because that's sort of, taking a look at the value of the entire business and then ignoring the capital structure for it as it stands right now, which is to say how much net debt or cash it has. But no matter how you slice it, this is significantly higher. So I think at this point, in the would you rather, I had been in the would you rather United camp, and I should also give some credit to my former colleague, Andrew Shirley, who I worked for at Ivory, because he actually pinged me on this earlier today. And this is a name that, this pairs trade is something that we've talked about on more than one occasion. And in fact, it's one of sort of the traditional pairs trades that we're always looking at, actually, because these are very close competitors. Excuse me, just going to shut that off for just a minute. And okay, so what to do at this point? Well, I think it's rather interesting. I'm going to see, I have another new little toy here that I've been playing with. Let's see if I can pull this up. Where is it? Here we are. Okay. I kind of like the work that these guys have been doing. So you see me use Bloomberg a lot. I've historically used Trade Alert, which is now owned by SIBO, for flow data. But there's this company, Unusual Whales, and I've been sort of toying with their application, and I rather like it. I'll hopefully be able to highlight this a little bit more in the future once I become a little bit more familiar with the process. What we're looking at right now are big trades in Delta, and you can see that back here, and by the way, this thing is using Pacific time, so if you're looking at these timestamps saying, wait a minute, options aren't open at 8:45 in the morning, you are correct. They are open at 8:45 in the morning Pacific time, though. And depending on which application I'm running, it's going to be showing what Eastern or Pacific time. But this was back in early December. We saw some big trades in longer dated Delta calls. And specifically, this one was the December 2025 80 strike calls. We saw somebody buy 5,000 of those. The trader paid about $5 a contract for those. Now, interestingly, those options are not that far removed from that price right now. So, oops, I brought up the wrong thing. So I'll bring this up. We can take a look at this in options play. So these things were about 540 or so when I was looking at this about an hour or so before the close. Let's take a look at where they are now. I'm just going to load that up in here. So this is the institutional trade. This isn't necessarily the one that I would recommend. I'm going to get to that in a second. Why? So actually the mid-market price as of the close was just 490. So those options can actually be had probably at or even slightly below where that institutional trader put those on just a little over a month ago. That said, I would like to make a couple points about this. So first of all, if you were to buy those 80 strike calls, stock needs to go up a lot for you just to break even by the end of the year. Now, these things have really been moving. Like I said, this is Delta's up almost 80% since August 5th of last year. United up, 180, so blowing the doors off. But so if we look at the upside break even of 84, I'm just going to call it $85, and we'll compare that to 68. So we're talking about an upside move of 25% by the end of the year just to break even. So a couple things about this trade. Number one, I'm not crazy about the fact that it needs to move up that much just to get to break even. Secondly, when they put this trade on, which was at the tail end of last year, those options expired in slightly over a year. Sometimes there can be benefits if you're intending to hold something for a very long time to at least giving yourself that option to push it into the subsequent tax year. This may or may not be relevant for you, but if it is, you could contemplate using January instead. The other thing, of course, is that we like to sell premium against longer dated premium, get into calendars, diagonals, things like that when we can. So what are we looking for before we go and do that? What we want to see is that the near dated options, number one, don't cross over the subsequent quarterly earnings release, which in this case is estimated to be April 10th, I believe. So we can look out as far as March. But the other thing that you want to take a look at is how volatile is the stock, generally speaking, outside of those quarterly earnings releases. So here's what we're going to do. We're just going to take a look at a longer period of time. And I'm just going to put up we're going to get rid of this for a second. You don't need to see that. Look at the historical volatility over approximately a 1 month period, 21 trading days, 21, 22 is going to be like that. Now, one of the things you're going to see here is the seasonal effect of earnings, right? So actually, before I put this in, so let's do this. So the median historical vol is about 29.5. Okay, so just bear that number in mind, and I'm going to throw it in here for a moment. So we can see the seasonal effects. Most of these, prominent humps that you see here in the chart are taking place around catalysts, most notably earnings. And you can almost any stock, you can identify these pretty easily because you're going to see these obviously discontinuous stock price. Discontinuous meaning that it doesn't, that there's a break in the price. There are jumps, as we sometimes call them. What we can see is that outside of earnings, if you were short 29.5, 30 vol, not a bad thing. So it turns out, and we'll see where this is now, but when I was looking at this earlier, the March options were trading about 33.5 vol. Yep, so that's where we're at, right? So we can see that, yes, 33 vol in the at the money, let's call it the 67.5. We're at 33.25, 33.5. So that's not a bad sale, right? So we've got earnings coming up on the 10th of April, and United reports typically after Delta does. So that's not necessarily going to contribute to volatility a whole lot. So the trade I think that you would want to do, rather than the one that was recommended by, or not recommended, but at least done by that institution, would be to get long a January call, lower strike preferably. So we're going out to January of 2026 now. Maybe the 70s or something like that, or the 72.5, so significantly lower strike. And then you can look to sell a nearer dated 75 strike call and maybe a 62.5. That was what I was looking at earlier, was the 62.5 puts. And you get a strategy that looks a little bit like this. So, hopefully you can see that. Obviously, far greater probability of profit. Bear in mind, so when I show these charts, there's something important I think that's worth noting. That probability of profit is being calculated as of the expiration date for the nearer dated option. So that has a probability of profit of about 64% between now and March expiration, which is slightly under 60 days away. That other one had a much lower probability of profit, but it's a much longer period of time. So just something to think about there. Which I think is kind of interesting. So there was another trade, another pairs trade that I've talked about other than these two airlines. It was back, I think we covered it on the live stream. I had to look this up because I published an article about it after I covered it on the live stream. And the article was published on October 24th. And what I was talking about was a pairs trade in Elf Beauty versus Estee Lauder. Long Elf, short Estee. And when I had that conversation, actually, I was using long and short call spreads as the way to articulate it. Unfortunately, I can't go back easily and retrieve it because rather than posting the trades when I wrote that article up, I pasted dynamic links, and the options I think have expired, or they probably have, so I'm not even going to bother to try to dig that up. Here's the important point I would make. So the question, and do we have that question? I don't know. Okay, so it was somebody posted that question for me. And by the way, this is one of the reasons why if you happen to miss the live stream, can't go into the live chat, have a question, especially if it's on something that I've previously covered, like the Elf Beauty Estee trade, throw it into the comments for this video or some other one, and hopefully we'll see it. And if we do see it and we have time, we'll definitely try to discuss it. So here's the thing. So like I said, October 23rd was when we said long Elf Beauty versus short Estee Lauder. And this was on, the article was published on the 24th, but we covered it, I believe, on the 23rd, which would have been that Wednesday. So since that time, and like I said, it was 2 call spreads. So this P&L that you have here, or the relative outperformance of Elf versus Estee, that isn't necessarily what you would have achieved had you, followed the recommendations I was making at the time. I was just saying long call spread Elf, short call spread Estee. It was a good pairs trade, as we can see. In the 3 months since then, nearly a 20% outperformance for Elf Beauty versus Estee Lauder. By the way, for those, you can go back and find that video, and I go over the rationale if any of you are interested. But the highlight of it is this, and I'll just show these things right now, and that is that Elf is growing and Estee was shrinking, and the two companies were trading at the time at very comparable valuations. That doesn't make sense. You should not pay the same valuation multiple for a company that is floundering and shrinking as you do for one that is succeeding and growing. So that was the rationale. But the question that I was asked was, how do I feel about Elf now? And this could have been somebody who maybe they saw that video and that's the reason they're asking it. I'm guessing it is, since Elf Beauty is not a name I get questions about that much. But lately, it hasn't been performing so spectacularly. So we can see, if we go back to October, obviously the stock is up. That's nice. It's outperformed Estee. That's nice. But this isn't a really pretty picture how it's behaving right now. And I guess this is probably more of a technical question than anything else. So what I'm going to do here is I'm just going to take a look at what the technical indicators have to say about it, sorted by this. And what we can see is that most of the technical indicators are not positive on the stock right here and now. So I didn't frame up a new trade for this one. It was really just in response to that question. I still think the valuation is reasonable given the given the growth rate that we're seeing, but technically it does seem a little bit weak. Okay, so let's see here. Let's move on to some other questions. Monday morning quarterback. Apple, I have a Jan 26, 215, 270 collar. Should I roll down? What is your general strategy if either side is challenged or is closer to expiration? I don't know if anybody happened to see this. I was on Fast Money. I guess it was about a week ago. And the question came up about Apple. Tim Seymour and I didn't quite see eye to eye on this one. He was he was bullish on the stock, and in addition to being bullish on the stock, the point that he was making about Apple, I'm going to get to the collar in a second. The other point he was making is that he viewed it as a safety trade in the event of a market pullback. I don't really see that. Really struggle with that, actually. A couple of reasons why. First is, over the last couple of years, the top line growth has been mediocre at best. That's not to say that EPS growth hasn't been decent, but EPS growth is bolstered by the accretive impacts of share buybacks. And the bigger the company gets, no matter how large their buyback regime may be, and theirs is a big one, as you start getting into the multiple trillions of dollars, which is how big this business is, the accretive impacts are going to end up shrinking on a relative basis, unless they really ramp those buybacks to be more substantial. So that was one of the reasons why I had a really hard time understanding why this thing is now trading at a pretty juicy multiple. We're looking at 30 times forward, and 30 times forward, that's at the high end as far as Apple's own valuation is concerned. It's above the market multiple. Compare and contrast that. I can remember a time when, this is before they got more creative with their balance sheet and sold a lot of debt. There was a time when if you bought a share of Apple and you could get this thing at 10, 11 times, almost 40 cents on every dollar worth of share value was cash. And we're just nowhere near that right now. So I don't really feel like, I'm not saying there's something really broken with the company operationally. I mean, there are issues where you have to contemplate whether or not they can expand their business, and there is clearly some pressure going on in China, which I don't think we can really ignore. But the long and short of it is that I'm not a huge fan of it. So with respect to this put collar, the 215-270, you certainly can contemplate rolling down, monetizing your hedge, is something I would think about doing here in a manner which is going to get it back to even money. So let's just show what you have. Whoops. Almost put in equity the way I would normally do that for the Bloomberg terminal. Okay, so I'm gonna put two of these things side by side. The one that you have, or are asking me about, which is the January, that's June. The January 215-270. So you're long the 215 puts, short the 270 calls. So at this point, if you had put this thing on, because remember when I have suggested these in the past as a long-term trade, usually we're looking at putting them on at something very close to even. So this one's now $6 in your favor, 3% of the stock price. So if you wanted to adjust this, something which I think is a fine strategy, by the way, you could keep the expiration the same, but look to migrate to a trade that is trading somewhat closer to even money. So to go even money, we can take this 215 strike down. Maybe we take it down to, let's see, what's this? That one is 945. So now you're getting, pretty close to even money here. So you could just move it down by, 10, $15 aside, arguably. If I do this, now you're actually going to be collecting a small credit. So if you rolled down to the 260, 200, trying to keep those percentages roughly the same, still give yourself a little bit more upside than you have downside risk. You're going to take, so you're collecting $1.30 in credit on this one, and you're collecting $6 in premium on the one that you're selling out of. So you're going to end up getting $7.30 a share. And so that's, a way you can monetize that trade. So something to think about, especially given, my general feeling about Apple here. I can appreciate that people who've owned the stock forever are not necessarily interested in selling it. And I'm not, I don't generally advocate that. I can contribute my 2 cents on what I think the fundamentals look like right here and now. But there's probably many times in the past where one could have said, "Oh, I think Apple's getting a little stretched relative to historical. Why don't you sell it?" And then depending on where you live, and depending on how long you've held it, maybe you have a long term gain, maybe you have a short term gain, and that can be very painful in terms of your total returns. So, okay. Southpaw 96. Hi, Mike. Thoughts on this Netflix position? 875, 885 call spread, April expiration, adjust, close, etc. Okay. So I'm sure you guys have heard me say nice things about Netflix in the past. It will refresh your memory if I use the following, which is sort of the way I tend to describe it. I think of Netflix as an unregulated utility. And I have previously criticized folks who have said that they aren't able to really adjust their prices. So we have differences of opinion. I do with some other people on the street regarding the elasticity of demand for Netflix services. They're the best in the space right now. I have to apologize to whatever analyst was saying this. And I'm trying to remember because I was in the middle of doing something else and it was going on the TV behind me. And one of the analysts was making a comment about those who would be critical of the big spend that Netflix is doing on the content side. So, I mean, obviously they're doing some spending on things like sports and so on. It was some time ago when Netflix was not a profitable business, did not have free cash flow, and people constantly complained that the company just spent every spare nickel that they had on content and the thing would never be profitable. And that was wrong then, and it is also wrong now. The thing that spending on content does is it widens that gap. There's a lot of competition in the streaming space. They're the best, arguably, and they can stay in that position if they continue to spend on it. And, I think it's really going to force some of these other streaming businesses to potentially pivot. I'm not sure what it's going to do to them, but this is the place to be as far as that goes. My favorite in the space. So the 875, 885. Whoa. Okay, so let's just take a look at this. I just realized what you have. So you are long a deep in the money call spread. So if you're long a deep in the money call spread, that is synthetically equivalent to being short the corresponding put spread. I may have to, that's an alarm, so I may have to get up in a second and just go check on something. Just make sure that there's nothing going on in the other room that requires my attention here. So, oops. This should be the 885. So this is really a deep... The way to think about this trade is you are now short an out-of-the-money put spread. Now, chances are this is going to continue to appreciate because it's actually a decent bit down from the current stock price. But this is sort of the risk-reward relationship you're giving yourself. If you think about this red zone, that's how much you're risking. And the green zone's how much you can potentially make from here. Not terrible. Not terrible. But it's not as good as it could be. If you want to hang on to those 875s and maybe move the short strike up a little bit, that's one thing you could do. But I would probably think about rolling this whole thing a little higher. That's my 2 cents. Still like the stock, but the risk-reward relationship to me isn't as favorable as it was. I mean, look, you had a big win. I don't know when you put this thing on. Obviously, the earnings result was great, up 10% or thereabouts. So nice trade. But I would contemplate rolling that one up, if not up and out. Okay, next. Thoughts on Uber 70 and Lyft long calls post quarterly earnings release. All right, so let's take a look at these. Just confirm when these earnings are. So Uber is going to be reporting on the 5th. Lyft is going to be reporting on the 11th. Big implied move for Lyft. I'm sure Uber's is pretty chunky as well. I mean, these companies, it's an interesting situation, right? Because GM electing to pull out of the robo-taxi business is a little bit of a problem, because that was a potential source of self-driving vehicles for Uber and Lyft. Waymo is, their own robo-taxi business. Tesla, in theory, could be its own robo-taxi business. So this is a bit of an issue. And you know what? I don't know if we can put on a standby for just a second. Because as soon as I get done talking about Uber and Lyft, I have to go and see what is going on with this alarm system. Because it's got me a little bit... I'm the only one present, so when things start going off, I need to double check what's happening, and I probably should do that. Uber I probably prefer to Lyft. I would probably think about, because of this big implied move, you might want to think about and it's a bigger one in Lyft. You might want to think about a spread. I think those are probably not a bad idea. So let's just take a quick peek here and see how one of these spreads might look. We'll pick a Feb. We'll choose the long 70s that you have here. Actually, let's do this. I'm going to use a long 70 on this one. Okay, so that's that. Need an upside move to 73.5 to compare that to how this thing has done over the last couple. So, the average move is just under 7%, but 73.5 is versus today's close. Oops. We're looking at 8.4%. So it's, you need it to move more than it has on average to the upside to see profits, assuming you hold it to expiration, right? It's not 100% necessary to do that. You could get a little bit of an upside move, monetize, roll, do something like that. But let's just compare and contrast that really quickly with a spread instead and see how that does. So when do I like outrights? I like outrights when the implied move is below the average. Here it's, in Uber's case, round about 7%, it's pretty much on the number. Whoops, and that was March. I'm sorry, you had Febs. So let's just go like that. Yeah, so 345. So that's that trade. We can go to Febs, do the same regular way. Choose a lower strike call, maybe even a slightly in the money one we could do, like a 67.5. And rather than, let's go 67.5, 77.5, something like that. So that's a little bit better. There we are. So improve the probability of profit. Now think about the short strike here. That's up almost $10. It's up $9.50 from the current stock price, which is 14%. That, by the way, I think is about the implied move we were seeing for Lyft. Probably the same thing holds true for Lyft as well. Again, because that one's got a big implied move, so something to think about that. And if you guys can bear with me for 1 second, I'm just going to step away for just a moment. Maybe we can flash up a, it's not going to be more than a minute. I just need to take a look in the other room and see why this alarm is going off, and I will be right back. Stay with me. Okay, sorry about that, folks. Thank you for your patience. No cause for alarm that I know of yet. Okay. Good morning, FidWest. Okay, so Dennis, you are asking, we would like to revisit another long call calendar spread trade on gold, like the one on GLD explained months or weeks ago. I don't remember when that was. So gold, and more accurately AU, Anglo Gold Ashanti, was one of the things that I had selected for my 2024 CNBC acronym. Gold obviously had a great year. I don't necessarily think that the things that were supportive of that are no longer valid, it should be said. So I'm not suggesting for those of you who own it, just because it wasn't included in my 2025 acronym, the acronym is only 6 letters. So generally speaking, I assume your portfolios have more constituents in it than that. So just because I didn't include it for 2025, between you and me, I still think it's an important component. Who was it? It may have been. It was either J.P. Morgan or Goldman Sachs recently put out a thing where they were saying that they didn't think it was such a great hedge against inflation. It isn't always a great hedge against inflation, but it is a very good hedge against inflation over the long term. The cost of a suit, the cost of a car, the cost of a house, if you go back 100 years and you take a look at what those things would cost in gold terms versus now, they're about the same. The dollar, meanwhile, is down 99% over that same period of time. So I don't know where they came up with this idea that it's not, and they're probably just taking, very short-term regressions and comparing the performance over short periods. And in that case, that can be a valid complaint. But over the long term, it's a very good inflation hedge. So ignore them on that. I don't know what they were talking about. You cannot go back in time and say, oh, look at how it performed over the course of the last 6 months. It's not a meaningful period of time. My acronym, I covered it on the last one was RISING, RISING, R for equal weight, ETF, S&P 500 equal weight, RSP. I was for IBIT, the ETF for Bitcoin. I used mostly ETFs because it was just easier for ticker symbol purposes, and it happened to turn into a nice acronym. S was for SCHH, which is a REIT ETF. The other I was for INDA, which is the India ETF. N was for Nance, which is the Democrat Subversive ETF Congressional Stock Purchase Tracker, and G was for a GOOGL. You could use Goog as well. Alphabet, basically. I don't really care whether it's the voting or non-voting shares. If you're wondering why some people buy non-voting shares, it's because if you are in the business, sometimes it creates a hassle. Okay, so in this we want to go, if you wanted a long calendar, well, actually, let's just take a quick peek and see whether the calendar makes that much sense versus just buying options outright or just owning the underlying. And we're going to look at vol for this. So white is the implied vol. Oh, okay. Looks very reasonably priced here. So I don't think it's even a bad idea just to own options in GLD at this point. They seem reasonably priced, but if you wanted a calendar, we can come up with one. I probably had multiple windows for this options play open. That's probably why that one was closed. But so it looks like the volatility going out 3 months at least is very reasonably priced. But if you're going to do calendars, we can probably stretch it out a little bit more than that. I'm just going to use June for the sake of argument. Why not? So something like this offsets the decay, decent probability of profit. So, buy something close to at the money. It's not a super high volatility instrument. And, the idea is just to be long it and then turn it into a poor man's covered call. So I think that would be fine for that. Let's see here. What else we got? Regarding your airline commentary, do you think it's too late or inadvisable to take a long position now in jets? This is for diffusing risk with any one company in particular. Here, did I share that? So, in general, I do like diversifying and, making sector bets. I will make a point, though, about this one, which is, it's worth considering. And that is that some of these airlines actually have material problems. So you can see here, for example, Southwest, Love. This thing is 10% of the Jets ETF. They've had two really big issues. So material distinctions between the way United and Delta operate, and American for that matter, and Southwest. So Delta, very strong hub spoke, big hubs. They just built out. So it's interesting because I have flown a lot in my life. And when I say a lot, I mean a lot. Millions of miles. I was flying back and forth across the country, probably doing 5,000-6,000 miles a week, most weeks for over a decade. So I know of where I speak on virtually all of that on commercial aircraft, unfortunately for me. I was a high status flyer on American and United, and I was not on Delta, and one of the reasons was because I flew into New York so much. United has a very strong hub at Newark, and American has a hub at JFK. LaGuardia is not great for sort of transcontinental travel. And Delta, back in the 2010, 11, 12 timeframe, had an absolutely terrible terminal at JFK. You didn't even know what country you were in half the time when you were there. It was just awful. And they have subsequently upgraded. So I believe, if memory serves me, Delta is now Terminal 4 at JFK, and it's the best one there. I think there's 8 terminals, because if I remember correctly, American was Terminal 8. I fly into Newark more often than not when I go to New York these days. Just more convenient to where I'm trying to get in Manhattan. But Southwest does not operate this kind of a model. Theirs is more point to point. And the reason this is important is because in order to make that work and work effectively, you need to have a pretty good software system for optimizing travel. Because, if you're going to travel on American and it's going to be from West Coast to East Coast, but you're not going to New York, you go to New York, you go to JFK, and then you have flights going out of there. Easy enough. United, you fly into Newark, similar situation. Or Houston, because United is the merger between Continental and United, so they had a big hub there. American has a big hub in Chicago. The issue that you have is that in Southwest case, they didn't do necessary software upgrades, and so I'm sure every one of you watching, if you paid any attention at all, know that Southwest had massive, massive problems. And the issue that you have is that if you buy these, Alaska also, I think, had some results recently that weren't so great. So it does offer you diversification, which can be a potential benefit. But sometimes, you know, you're diversifying into things you don't necessarily want to own. The other thing I would say about Southwest, just to bring this up, Southwest is one of the airlines that hedge their fuel costs. That's now, I don't know how meaningful and impactful it's going to be, Trump's drill baby drill comments, but it's worth pointing out that if you have fuel hedges on and we start seeing a leveling out, then that's going to come at a cost, and that's not helpful. Some of these other airlines do not hedge. Delta has a kind of a hedge because Delta, among other things, they have their own refinery. So, you know, they have a little bit of hedging going on because of that. So this is one of those things where I think the diversification that you want is probably better it's going to be better to get that diversification just from your general portfolio rather than saying, okay, I want to own, you know, 20, 30 different stocks within the airline space. You know, they've also got Boeing and Airbus and Bombardier and things like that in jets, which, you know, that's a little bit different. So you buy jets thinking, oh, I'm getting airline exposure, and you are primarily, but you're also getting a lot of other stuff too. And, you know, it's, you know, up to you, but I would probably just focus on the best of breed in this one. These things are trading at single-digit multiples, it should be said. You know, Delta's trading like 8 times. Got a 10% free cash flow yield versus market cap, 7% versus enterprise value. So, and, you know, you can get your diversification elsewhere. That's, again, my 2 cents, you know. Okay, Alex B. Today, SPX and VIX is up, getting close to correction phase. Okay, so that's a really good question, because for those of you who have followed comments that I've made many times over the years, one of the things that I observed during the tech wreck and the period leading into it was that, what did we have? What was the recipe of things that was going on at that time that was problematic? We had astronomical valuations in a handful of places. Some of those valuations were almost hard to quantify because you were dealing with the sort of pets.com types of stocks, companies that didn't have profits. Their survival was obviously very questionable. You had companies that were trading at nosebleed valuations that didn't have enormous long-term moats. AOL, you know, the Time Warner acquisition or merger with AOL was a perfect example of that. And then you had businesses that appeared to have really good, and businesses with big moats were in the right places from a secular perspective, you know, in the hub of it, Internet of Things types of conversations, Cisco being the most notable example. But the valuation was just a little bit too rich. So our valuations are high now. They are not as high as they were then. The other thing, though, that concerned me is that what we saw is that rather than implied volatility in the broad market remaining constant at a relatively low level or falling as the market rose, we often think about volatility and stock prices being anti-correlated. What we ended up with was something very, very different. And what that was is that we started seeing volatility rise even as stock prices were also rising. So let's take a look. If I go in here and let's see if I can get the price. I don't have implied volatilities for this stuff. VIX is a measure of implied volatility, but I will point out that there's a very good and tight relationship between the VIX and realized volatility on the underlying index. So we're going to have the SPX price here, and I'm just going to pull up VIX because I believe although it wasn't necessarily, I think they calculated it retroactively going back to that time. There we go. Okay, yes, so sure enough, there it is. I actually probably shouldn't have put 98 in here because we're dealing with sovereign defaults. There was the collapse of the Asian tigers in the late 90s, and there was also the Russian default. So I'm going to skip that. We don't want to look at that. And why don't we just go to 01. Okay. So what we started, so it was right in this period, right about where my cursor is. So this was the zenith for the S&P, was March of 2000. And what we can see is that the realized volatility, I don't know if you can see this right here in orange, the market started to get more volatile even as the stock market prices continued to rise. And this was really the issue. Take a look, by the way, at how high this volatility was. It was, we're looking in the mid 20s or thereabouts. Compare that to where we are now. We're really not at those types of numbers. I mean, it was basically double where we are right now in terms of realized vol. And actually, I should be looking at something a little bit shorter, like 21, 30 days. But yeah, it was about double what we have. So we're not quite at the warning track level as far as I'm concerned. But valuation is a concern. And of course, geopolitical things, who knows. But I will say that you start creeping up into the 20 numbers, then that's where you start to really get a little bit more anxious, because that's not a normal course of events. So to put and that actually is probably a good way to think about it. So I don't know if you have this available to you, but what we're going to look at right here is where volatility is compared to its long-term average. So we can see that the 1 month, I'm using realized trading days or sessions, as Carter Worth will sometimes refer to them. Realized volatility is less than 15 right now, and the mean is about 15. So it's not even above average. It is above the median, and this chart actually does point out an important thing to think about when you're looking at vol, which is that the mean, which is just an arithmetic average, is a little bit distorted. And the reason it is distorted is because volatility, it can't go lower than 0. 0 is what it is when the market doesn't move. But it can get very high. I mean, we can look at 1 month volatility got to almost 100% here. So you can have a lot of days of 10 vol, and then you throw in 100 vol, and suddenly the average is thrown completely off. So you also want to pay attention to this median, but we're not above average yet. I think once you start getting up into the high teens, 20-ish, that's when alarm bells start going off. The other thing that you want to look for are just what I was talking about before, which is price jumps. Price jumps in the market. So not just price jumps in individual stocks, because you get those all the time. You get a quarterly earnings release, news is better than expected or worse than expected, the stock reprices. But when the market starts repricing, where you get gaps and real price discontinuity in something like an index, which is theoretically diversified, that is more reflective of anxious risk-on, risk-off behavior. So I would put that into your calculus. How would you play short or long MicroStrategy options, giving Bitcoin upscale price predicted under Trump presidency? So, I mean, the first thing I would say is, people will know that I'm, bullish on Bitcoin. Have been for a while. I actually, it was the first letter in my acronym for 2024, B for Bitcoin. It's the second letter in my acronym for this year, I for IBIT, which is the ETF that tracks Bitcoin. MicroStrategy is a levered way to play it. There's actually going to be some other interesting things going on, which is that they're now releasing an ETP that will buy Bitcoin-related bonds, which I thought was kind of interesting. I'm not sure that that's really necessary. It's kind of an interesting hybrid security, right? Because MicroStrategy, they borrow money, they use the borrowed funds to buy Bitcoin. The borrowed money is not borrowed with an interest rate per se, because they're typically zero coupon converts. So effectively what happens is you sell $1 billion worth of bonds. Because Bitcoin and MicroStrategy are highly volatile, you can have a conversion price, which is where the bonds convert to the stock, that might be 40-50% higher than the current stock price. And the buyer of that bond, therefore, will benefit if the price of Bitcoin goes higher above that conversion level. Make sure that thing, I'm going to turn this thing off because the interesting thing about the bonds, of course, is that you're senior in the cap structure. What does that mean? That means that the company owes you that money regardless. Now, in a normal circumstance for a business that had sort of something outside of speculating on Bitcoin as part of its operating income, this would be more meaningful to me because they don't as part of their scale. So let's just, let's look at this way. We're closing on an hour, but yeah. So you're dealing with a business that's $100 billion market capitalization with $500 million in revenues, and it's not making any money from their software business. So if the value of Bitcoin falls, then the problem for the guys that buy those bonds is that, sure, you're senior to the equity, but what are you going to get repaid with if the company doesn't have any meaningful operating income? So to me, that's, I don't know how much of a benefit it is to be senior in the cap structure. If Bitcoin goes, MicroStrategy is going to go too. But it is, it has some leverage. But here's the thing I would ask you, which is, if you want leverage, why not get your own, which you can. You could buy call spreads in IBIT. And that's effectively what MicroStrategy gets. Borrows money, sells essentially calls on its own stock up 50%, and, buys Bitcoin spot. So it's, if you could lever your own trade. You could do call spread riskies and things like that. They're getting a little bit short vol, by the way, right? Because if you're issuing converts, then you're taking on debt and you are selling upside calls on your own stock. So they are getting short vol. They're taking advantage of the fact that there's vol. It's not a free lunch. I think it sometimes gets described that way. People are like, oh, he sells bonds and it's accretive. It's accretive for the first 50% appreciation in Bitcoin. But I don't see any reason why you wouldn't just trade Bitcoin. I think I'm very impressed with Michael Saylor. I'm surprised more companies aren't doing what he's doing. I'm sure others will follow now that they've kind of recognized, hey, wait a minute, why aren't we doing that? But I don't see anything wrong with just being long Bitcoin as well. My colleague Mark Guthner, by the way, he had recommended MicroStrategy on the Options Edge website a couple of years ago, and he's been long it himself with, as you might guess, significant success. I think his wife gave him some money for safekeeping for something she wanted to purchase, and she probably doesn't even know what that's turned into in the meantime, because I think it all got put into MicroStrategy. Okay, so where was that question I was just seeing? Okay, Mike, with the prices of fuel and airport costs per passenger at about $48 per person, why even get involved with the airlines now? So the biggest expenses for the airlines are fuel and labor. We did just have a whole bunch of contract renegotiations on the labor side, and a lot of these things were significantly higher, but these forecasts price that in. It's really a demand issue, and there is another important point, which is that one of the most important things to worry about with the airlines is capacity. When they start getting overly optimistic and building out their capacity too much, what ends up happening is that you go on to Kayak or Google Flights or whatever, and suddenly you're able to take really cheap flights because they're just trying to fill the seats. If any of you have flown recently, you know there is not a capacity issue right now. Well, there is a capacity issue, under capacity. Every single time I am not flying anywhere near as often as I used to. It used to be a weekly thing. Now, might fly a couple of times a year. But I will tell you that, I just flew to Miami not that long ago, and the flights, and I did a flight switch, the flights were all overbooked. That's a good situation for the airlines. When you go to the, board your flight and you're hanging out at the gate and they're saying, we're looking for 5 volunteers to take another flight. We're going to give you travel vouchers, this and that and the other thing. Things are good for the airlines at that point. So right now they're pretty good. I don't expect the airlines will not, should not, and generally do not trade at a market multiple. So when I say, it's trading 8 times earnings, that's not with an expectation that it should trade 24 times earnings like the broad market, just to keep the number simple, 3x. I'm just saying that with a free cash flow yield of 7-8% on an enterprise value basis, 10% on a market cap basis, that's a pretty good business. Also, I forgot to mention, actually, it just occurred to me, in addition to this whole issue about Delta having that better terminal at JFK, they have a younger fleet than United does. I think their average fleet age is not a young fleet, 15 years, but I think United's is over 19, so that is also a potential advantage. And that what made me think of that, of course, is that another big expense, although it's an investment expense, is going to be the aircraft themselves. Okay, so let's see here. I'm going to try to punch through a couple more questions, and then we'll see if there's something here that we can get to. Oh, I've gone well over my hour. Is there anything else here that... can you highlight... Yeah, we were talking about Uber, so I might as well have this follow-up question. From an options data perspective, what's going on with Uber? So, you know what? I'm going to show you the difference here. So this is what's going on with Bloomberg, but let's pull up our options whales and look for some big trades and see what was going on in there. Here we go. So these are the biggest trades. Most recent ones are populating at the top. So here we have a bearish trade. By the way, these are all going to be opening trades. So these are going to be situations where the volume in that contract. So green is showing that they were lifting offers. So in this case, buyers of the month ending 66 strike put in Uber, which is interesting because that's prior to earnings. So we can see that the 3 biggest, most recent trades in Uber were bearish. And let's have a look at Lyft. Oh, this is interesting. So June 14 calls, 500 of those trading for 2.25-ish. So some bullish activity there, but we have a couple other bearish trades too. The biggest one here being these month... Oh, you know what? So we saw this in Uber also. It was the month-ending puts that were seeing a lot of activity. 3,500 of these Jan 31st month-ending, so 9-day, 13.5 puts were trading. And this doesn't seem like a whole lot of money. We're talking about 30 cents or so, but on a $13 stock, that's not inconsequential for an option that expires in 9 days. And talking about expirations, because I've gone over the full hour that I normally allocate to this live stream, our time has also expired. For those of you who tuned in, thank you very much for doing that. Like, subscribe, notification bell, tell your friends, and join us here again on Monday. And actually, we're probably going to do another one on Friday. Mark and I are going to try to do that more regularly. He's trying to jam it in. I realize that his semester has just begun, and he probably has students banging his office door down because the semester is just getting going. But we may also do a live stream sometime in the middle of the trading day on Friday. So if you have the notification bell and we do that, you'll be informed and can join us then and ask both of us some questions. Thanks for watching.